tie it all together, how can we convert income under variable costing to absorption and vice versa? So you can just restate it using this following formula. You can memorize this if you want an easier way. You can always recalculate all the numbers, or you can just memorize this. Income under the absorption costing is equal income under variable costing plus fixed factory overhead and ending inventory minus fixed overhead cost and beginning of the inventory. And that's because these fixed overhead costs, it's a timing difference for our absorption costing. Our absorption costing is capturing it when it's sold. So if we just back the fixed overhead costs out of the beginning inventory and add in what was in the, back out what was in the beginning inventory and add what was in the ending inventory, we could go into an income under absorption costing. So we have an example here. So variable costing income, absorption costing. If there's no beginning and ending, so if this is the first year, no beginning and ending, it's going to be the same, right? Because inventory costs, it didn't change anything. The only difference is if we sell different amounts, of inventory. So we have nothing deferred in ending inventory, nothing recognized in from beginning inventory. And then year 2, or 2018, our variable costing income was 120,000, but we had fixed overhead deferred from the beginning balance of 20,000 times 10. So we're saying there's 20,000 units here in ending inventory that we deferred. So we're going to add the 200,000 because those would be recognized in this year because there was an ending inventory. So from a variable costing perspective, we didn't recognize it. But from an absorption cost, let's say fixed overhead cost deferred in ending inventory. So from an absorption costing standpoint, we would allocate those fixed overhead costs. Were allocated from the prior period and expensed in this current period. And so our variable costing income is going to be less than our absorption costing income because we're deferring the 200,000 to this next period. That's what it's saying. That's what it's tying to here. This 200,000, we're saying we weren't able to sell it, but from a variable costing standpoint, that doesn't matter. We'd still recognize it as a loss in our income, right? It still goes into our fixed costs and we'd lower our income from it. But from an absorption costing standpoint, it's doesn't hit our income statement. It's part of our inventory because we weren't able to sell it. So we're deferring it because it's part of our inventory. So we're saying 200,000 of costs here were included in our variable costing. So our variable costing is $200,000 lower, but it's an inventory on our GAAP financial statements. So it'll have to be expensed next period. And then the next period we expense it, which results in our absorption costing income being less than our variable costing income. So I think this is a great slide to really understand how the flow works, right? So if there's no difference, if we had no difference in beginning and ending inventory, or no beginning and ending inventory at all, then we have the same calculation because there's none of this. All of the fixed overhead would have been expensed under GAAP accounting because it's expensed in inventory and it's also expensed in our variable costing statement, right, under the fixed expenses. But then if we have a difference in inventory, if we have an ending inventory balance, our variable costing would expense it because we spent money for it. But for our absorption costing, we would expense it in the period where we sell the inventory due to the revenue recognition and matching expense recognition principles. You match the expense to the period that revenue is recognized, and you recognize revenue when it's earned or when we sell the inventory. And so we defer it here, and then it'd be expensed here. And that's why we get a difference in income based on if we produce more than we sell or we sell more than we produce. So understand these inverse relationships. And we can think of this from a strategy standpoint. Absorption costing can result in overproduction in this case, because if we look at our absorption costing income here, right? We've produced more, our income's a little higher, and so we can say that, wow, we're making more money than per unit because of our because our inventory was deferred, our costs were deferred from fixed overhead. So we'd be thinking, wow, we're making more money per unit, we should produce more of these units, when in fact we might have a ton of book costs in our inventory that we aren't accounting for. So we're going to wind up in an overproduction situation and think that we're a lot more profitable than we actually are. So what if we happen to produce 100,000 units instead of 60,000? And so if we're looking at absorption costing, total production costs per unit, or I guess this is looking at when 60,000 units produced versus 100,000 units produced. From a variable costing standpoint, we see that it's cheaper if we're making 100,000 units are produced. So the 40,000 extra units would be stored in inventory, and the total production cost per unit is $4 less, right? Total cost per unit is less. So, hey, that means that this is probably a good decision, and it'll be hidden in inventory. That's what they're saying here. But from a absorption costing perspective, it would increase our income under absorption costing. This is just going back to what we were saying before, is greater if manager produces more units, because we're deferring some of the overhead costs to those units that are being stored in inventory. This is going back, I'm just summarizing the money, the concept that I was stating earlier, right? That more of the money, over this fixed overhead is being allocated to this larger amount of units. So our income would be higher, right? Because we're deferring that fixed overhead. But under variable costing, we're going to see a more accurate representation. The expense is still going to be the same because we're always going to recognize the fixed selling and administrative expense and our fixed overhead in, our fixed overhead is really the main difference. We're going to recognize that in the month where it's incurred as a fixed cost. So this isn't going to be distorted by the differences in inventory. So if we don't have a different set of books for variable costing, then it incentivizes managers to overproduce so that they can defer or hide some of those overhead costs into inventory. But in reality, from a business perspective, it's very expensive to store inventory. It's not productive. And so your variable costing is going to give you a more accurate representation of how it should be, how the business is actually operating in this sense. So any large manufacturing company that I've worked with has a set of GAAP books and internal reporting books, because you need your GAAP books for your external auditors and your external presentations and your financial statements, but you need your internal management books in order to make sure that your managers aren't trying to skew the numbers by overproducing, being ineffective with their inventory management. And then